Hello everybody, this is 𝗪𝘆𝘀, your instructor from My Learning Center. We'll talk about 5 essential elements of a small business acquisition loan. It can be hard to get a loan for a business acquisition. Meeting the conditions for a small business purchase financing could be, to put it mildly, challenging. If the business being sold is exceptionally profitable, the selling price likely includes a substantial amount of goodwill, which can be very difficult to finance. Even if the underlying assets being purchased are worth substantially more than the purchase price, finding loans may be challenging if the business being sold is not profitable. Depending on the particulars of each transaction, loans for business acquisitions or finance for a change of ownership may vary substantially. However, the main obstacles to securing a business purchase loan are described below. Promote goodwill. Goodwill is defined as the sale price less the resale or liquidation value of the firm's assets, minus any unpaid debts secured by the assets. It is an indication of the surplus profit the business anticipates making over the value of its assets in the long run. Generally speaking, lenders are reluctant to finance goodwill. To complete the sale and/or secure vendor financing in the form of a vendor loan, a greater down payment is consequently now required. Vendor assistance and vendor loans are routinely employed in the selling of a small business. If they are not explicitly specified in the conditions of sale, you may want to ask the vendor about potential support and financing options. There are several wonderful reasons why asking the question might be worthwhile. To get the greatest sale price possible, which most certainly includes some goodwill, the seller will agree to finance a portion of the sale by allowing the buyer to pay a portion of the sale price over a specific period of time under a structured payment plan. The vendor could also offer temporary transition help to make sure the transition goes successfully. Due to the vendor's support and financing, which together create a positive vested interest, it is in the vendor's best advantage to aid the buyer in a seamless transition of ownership and operations. Not doing so can prohibit the vendor from getting the entire sale proceeds in the future if the company struggles or fails under new management. This is often a highly attractive characteristic for potential lenders, given that the risk of loss due to transition is greatly reduced. The ensuring finance challenge is directly addressed by this. Risk of organizational transition. Will the new owner have the skills necessary to run the business as successfully as the previous one did? The client's employment with the new owner, will they be continued? Did the previous owner possess a unique set of abilities that would be difficult to replace or replicate? Are the key employees planning to remain with the company after the sale? The company's ability to run profitability at a level of performance no lower than its current performance level must be believed by the lender. Financial plans normally require a buffer to allow for potential changeover lags. In addition, a lot of buyers purchase a business in the hopes of taking advantage of the massive development they perceive to be possible. It is vital to persuade the lender of your business's potential for growth and your ability to deliver better results. Sales of assets and shares are comparable. In an effort to pay less in taxes, many sellers look to sell the stock in their business. Nevertheless, unless otherwise stated in the purchase and sale agreement. The buyer will then be liable for any ongoing and any future liabilities connected to the continuing concern business. If a small business acquisition loan application is considered in conjunction with a share purchase, there can be a greater perceived risk because it can be difficult to assess potential business responsibility. Risking trading. Is the business's sector a mature one that is growing, or one that is tumbling? In what way does the business interact with the dynamics of the market? Changes in control, will they strengthen or weaken the company's position in the market? The company's ability to maintain success for at least the time the business acquisition loan will be in effect is something that lenders must confirm. This has significance for two reasons. The process of payback will unquestionably be made simpler with a steady income flow to start. A robust going concern business is more likely to be sold, which brings us to our second point. In the event that an unforeseen circumstance prohibits the owner from operating the firm, the lender will be assured that the business can still make enough money through sales. Any outstanding debt will be repaid with the proceeds. In comparison to a company selling to a bigger geographic area, localized markets are substantially easier for a lender or investor to assess. Additionally, lenders in the area may be familiar with the specific business and how well known it is in the area. Individuals' wealth. The majority of business acquisition loans require that the buyer have a tangible net worth at least equivalent to the remaining balance of the loan, be able to pay at least a third of the total purchase price in cash, and still be able to do so. According to statistics, businesses with high levels of debt have a higher likelihood of struggling financially and defaulting on their loan arrangements for new venture financing. Increasing the size of the business purchase loan is associated with a higher risk of default. Thank you for listening, folks. Join our Facebook group, 𝗪_Learning Center, and subscribe to our channel on YouTube, 𝗪_Learning Center.